Hello, welcome back. My name is Nestle Benoit with TransFlorida School of Real Estate, and today we're doing some real estate exam practice questions. We're going to focus on the area of residential mortgages. These questions represent about 9% of your Florida State exam. So let's jump into some questions. Question 1. A defaulting borrower may avoid foreclosure by giving the mortgagee. Again, it's good practice to always repeat the question and make sure you understand what is being asked before looking at the answer choices. So here we go again. A defaulting borrower may avoid foreclosure by giving the mortgagee A promissory note, B, a deed in lieu of foreclosure, C, a redemption notice, or D, a list pendant. Answer is B, a deed in lieu of foreclosure. This occurs when the mortgagor transfers ownership of the deed to the lender because the borrower cannot repay the lender's loan. If approved, borrower will avoid a foreclosure. Which laws or regulations require mortgage lenders to provide an estimate of closing costs to a borrower and forbid them to pay kickbacks for referrals? Again, which law or regulations require mortgage lenders to provide an estimate of closing costs to a borrower and forbid them to pay kickbacks for referrals? A. The Equal Credit Opportunity Act. B. Truth in Lending Laws. C. The Real Estate Settlement Procedure Act. D. Federal Fair Housing Laws. The answer is C. RESPA. RESPA requires lenders and others involved in mortgage lending to provide borrowers with pertinent and timely disclosures regarding the nature and cost of a real estate settlement process. Also prohibits kickback or referral fees for settlement services. A lender is charging 3 points on a $500,000 loan. The borrower must therefore pay the lender an advance amount of. Again, a lender is charging 3 points on a $500,000 loan. The borrower must therefore pay the lender an advance amount of A. $1,500, B. $3,000, C. $15,000, or D. $30,000. Answer is C. $15,000. The discount point is interest paid in advance. It sometimes protects or increases the lender's yield. It also helps the borrower obtain a lower monthly interest rate by paying the points in advance. Here, to calculate the discount point charged, multiply the discount point 3% and the loan amount equals $15,000. The principle of the role of Veterans Administration in the mortgage lending market is to. The principal role of the Veteran Administration in the mortgage lending market is to A. Guarantee loans made by approved lenders, B. Insure loans made by approved lenders, C. Purchase loans made by approved lenders, or D. Originate loans made by approved lenders. The answer is A. Guarantee loans made by approved lenders. VA loans usually are at a lower interest rate than a conventional loan. Also, borrowers pay into a VA funding fee at closing. The purpose of an income ratio in qualifying a borrower is to. The purpose of an income ratio in qualifying a borrower is to A. Safeguard against over-indebtedness, B. Compare one's earnings to one's short-term debt, C. Identify the highest possible interest rate that the borrower can afford, or D. Quantify the borrower's assets to the fullest extent. The answer is A. Safeguard against over-indebtedness. The income ratio helps lenders determine a borrower's ability to pay a new loan. The income ratio equals monthly housing expense divided by gross monthly income. For FHA loans, the income ratio should be under 31%. Conventional loans under 28%. VA loans do not use an income ratio to determine the loan. Which of the following is true of a loan with negative amortization? Which of the following is true of a loan with negative amortization? A. The loan is an interest-only loan. B. Payments are not sufficient to retire the loan. C. The loan balance is diminishing or going negative. D. Additional interest is being added to the monthly payment. Answer is B. Payment are not sufficient to retire the loan. This happens because the payment on the loan fails to cover the interest due on the loan. As a result, the shortage is added to the principal balance of the loan. A homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for the loan. The homeowner retains the title to the property. This is an example of. Again, a homeowner borrows money from a lender and gives the lender a mortgage on the property as collateral for the loan. The homeowner retains title to the property. This is an example of A. Intermediation. B. Forfeiture. C. Hypothecation. D. Subordination. The answer is C. Hypothecation. Just remember to hypothecations pledge collateral and retain title. The process of enforcing a lien by forcing sale of a lienee's property is called. The process of enforcing a lien by forcing sale of the lienee's property is called A. Execution. B. Attachment. C. Foreclosure. D. Subordination. The answer is C. Foreclosure. Foreclosure is the legal process by which a lender attempts to recover the amount owed on a defaulted loan by taking ownership of and selling the property. When the terms of the mortgage loan are satisfied, the mortgagee. When the terms of the mortgage loan are satisfied, the mortgagee A. may retain an overage in the escrow account. B. may inspect the property before returning legal title. C. may be entitled to charge the borrower a small fee to close the loan. D. may be required to execute a release of mortgage document. The answer is D. may be required to execute a release of mortgage document. Most liens will require an executed release to be removed from title. A lender who charges a rate of interest in excess of legal limits is guilty of. A lender who charges a rate of interest in excess of legal limits is guilty of A. redlining. B. Usury. C. Profit taking. D. Nothing. There are no legal limits to interest rates. Answer is B. Usury is the practice of making unethical or immoral monetary loans that unfairly enrich the lender. And for the last question, the difference between a balloon loan and an amortized loan is, again, the difference between a balloon loan and an amortized loan is A. An amortized loan is paid off over the loan period. B. A balloon loan always has a shorter loan term. C. An amortized loan requires interest payments. D. A balloon loan must be retired in 5 years. The answer is A. An amortized loan is completely paid off on your final payment.